Hello there, Prof. Aram here, and in this video we're going to see why is it that the realized return on our investments are usually different from the expected return that we had in mind when we invested in those assets. So let's get to this. The return on any stock traded in financial markets is composed of two parts. The first part is the expected or the normal part of the return, which is the part of the return that shareholders predict or expect to receive from that investment. This return depends on information shareholders have that bears on the stock, and it's based on the market's understanding today of the important factors that will influence the stock price in the coming year. The second component, the unexpected component, is the uncertain or the risky part. This is the portion that comes from the unexpected information released during the year. A positive example of the unexpected component can be a pharmaceutical company's R&D project being approved by the FDA. Or a negative unexpected component might be the death of a experienced and charismatic CEO. This unexpected component can be positive or negative, but over time, the average of this unexpected component is going to be zero. And that's why, because of this second part, the unexpected part, your realized return is usually different from the expected return that you have from that investment. So the total return is the actual return or the realized return in an investment, and it has two components, the expected part and unexpected part. This unexpected part is where the uncertainty or the risk is coming from. And the unexpected part of the return has also two components. There is one that is systematic portion of that unexpected return, and we have an unsystematic portion of that return. So I'm going to go over these two in a minute. But keep in mind that the total return is the expected part of the return plus the systematic part of the return and unsystematic part of return. Keep in mind that we are always following the announcement and news when it comes to our investments. Announcement and news contain both expected component and a surprise component. What does it mean? Let's say we have expected and surprise. So let's say the XYZ company is going to announce earnings this Tuesday. And the majority of the analysts forecast that the earnings are going to be $10 billion. If the company comes out and make an announcement regarding the earnings and tell that we're going to have 10 billion in earnings, then nothing will change in the price because this analyst forecast is already baked into the price of the stock today. But if our earnings in the last quarter was 20 billion, then this is a positive surprise. This is a positive news. This is a positive unexpected component of the return. Because the company is beating the analyst forecast in terms of earnings, you're going to see a positive reaction in the market, and you see the stock price will increase. And on the other hand, if the company comes out and announces that they had like 8 billion in sales, this is going to be a negative reaction because the forecast or the expected analyst forecast was 10 billion and it was baked into the price. But when they come out and say we only had $8 billion in revenues, then this is going to be negative news, negative signal because they didn't meet the analyst forecast. In terms of efficient markets result from investors trading on the unexpected portion of the announcement. the easier it is to trade on the surprise, the more efficient the market is. And efficient markets, of course, involve random price changes because we cannot predict the surprise part of the return, the surprise component of the return. I hope you find this video useful, and thanks for watching.